Rob's Child, No Investment Advice. Welcome back to the series where we review every chapter of Benjamin Graham's The Intelligent Investor 1972 Revised Edition. Link of the whole book is below. I recommend reading the chapter and then watching the videos. My intention with these videos is to review the content of the chapters as well as provide some commentary into how the lessons may be applied to what's going on in today's economy as of July 2024 and how it relates to his older book, Security Analysis, the biblical version of this. Today's chapter is Chapter 11, titled Security Analysis for the Lay Investor General Approach. I feel like I'm just going to start off with a little joke. I feel like any book regarding finance or the economy should probably leave out Chapter 11 just as like a superstitious thing, kind of like how oftentimes buildings will leave out a floor 13. If you've ever seen an elevator that has more than 13 floors, sometimes they go from 12 to 14. There's no 13th floor because people think it's unlucky. Yeah, so this has nothing to do with Chapter 11's, but yeah. Let's go through the chapter. So we start with sort of a reminder that this and really all of Graham's work is focused on security analysis, not financial planning or market analysis. These are important areas, and this is not Graham's field of study. He doesn't do financial planning, and he's not talking about market analysis. He even says many times throughout his book how there are people that are great market analysts, and it's the most rewarding thing to be a great market analyst, but it's the hardest thing too, similar to being able to predict interest rates. It's the most rewarding and the most difficult, and that's not what we're doing here. We're trying to figure out how to analyze individual securities. He goes on to talk about how to find stock valuation / safety almost always is arbitrary. Growth stocks are even much more complicated to price. So, disclaimer, we can guess at whether a company is probably undervalued or probably overvalued, but it's all fairly ambiguous and nobody has a crystal ball unless you watch my regular show. Okay, and he goes throughout this chapter talking about future earnings and past earnings and the good things and the problems with it. And what we start off with this statement that the more you rely on future earnings versus the past, the more arbitrary and dangerous the valuation is, as right or wrong it can be, obviously. And then there's a footnote on how this compounds in the longer out it looks on earnings growth. We get into more detail about this later in the chapter. And then he references another book he wrote, The Interpretation of Financial Statements. He then discusses coverage of interest or coverage of preferred dividend payments, that higher interest might allow lower times coverage. Basically, when inflation is higher, I think the idea is that you can have, it means that the economy is kind of overheating if interest rates are higher than normal, and so business is booming, and the amount of earnings, think about it. If interest rate is 1%, for example, just as a hypothetical example, and your calculation is it has to have 5 times, coverage, that's pretty high, but, 5 times coverage of interest payments, 1%. But let's say rates go up to 2%. Well, then that's, the equivalent of 10 times the 1% versus 2% just from an interest rate change. That's the whole point of that statement. Something I've mentioned in other videos and my videos going over security analysis, I want to note that it seems today investors are less concerned with the amount of earnings coverage than ever before. This has somewhat to do with the great financial crisis of 2007. with PE ratios staying above 20, never really ever going below there, because people are now reliant on the whole system is reliant on the government and the Federal Reserve to basically come in and save the day. It's almost like nobody can ever go bankrupt, and I see that as maybe even coming into that might change actually right now in 2024, in my opinion. And my opinion has to do with the fact that inflation seems like a bigger problem than bankruptcies, I guess. I think the Fed right now, my whole crystal ball show and all of that, is going to try to fight inflation more than they're going to try to save businesses in this cycle. But anyway, and that's why I say that I think this is a very important point to bring out. I should put some stars next to it there. It seems today investors are less concerned with earnings coverage than ever, because who cares? The government's going to bail out everybody anyway, so why not why not add more leverage to your balance sheet and take out more loans and increase the risk higher and higher, in the name of competition, in the name of, this is just what we have to do. It's like, it's getting dangerous out there. But today, 2024, July, end of July. Moving on, other important bond preferred share factors, discussing number 1, the size of the enterprise, number 2, stock equity ratio, number 3, property value, formerly protected bonds, but without earning power, the hard assets can lose value. So these are obviously just the sort of risks and stability factors of a company being able to pay their bond payments and or their preferred shares, depending on the structure of the preferred shares, obviously. All right, and then he discusses again how railroads that survived had great coverage of their earnings. I'm going to bring up again, it still seems to me today that coverage of earnings has become less and less important in like every industry. But anyway, I digress. All right, yeah, I wrote here in my notes too. Again, I'll add, I think today's security markets are incredibly fragile when compared to the tests of the past, especially regarding, this railroad comment here. And then we talk about over expansion in industrial led to instability. So more bonded debt, how you can have a company that's over bonded. Basically, when a company goes to a bank or is, just selling bonds to whoever, they're increasing the leverage of the stock. So the company's bigger, so they have more money that they're controlling, that they're trying to use to create more earnings. And so, if the stock stays the same, they're not raising more capital by, selling more shares, then it leverages the value of the stock. So if that new money coming in that they're borrowing is making a good amount of money, then all that benefit goes to the stockholders. It's great. But if that money does not successfully make more money, let's say it loses money, it actually leverages it to go the other way. And that's what can happen, especially when companies overexpand and get too much debt too quickly. They think they can just keep growing forever, and they keep borrowing more money, and this can happen, and it cannot be good for companies. I will note here too that from security analysis, he discusses this at length in security analysis, how this often happens in companies because honestly a lot of it has to do with CEOs wanting basically a bigger company to rule over, which increases his personal income and power and marketability on his own 2 feet. He can be the CEO of a new company someday. If that's the CEOs want the biggest company, it's natural to want that. And and problematic. And the other thing that ties into that from security analysis is the ties between the board of the company and the CEOs, and how, that's just something to be aware of if you're trying to analyze a company. Then we have a section, supposed to say section, titled Common Stock Analysis. Again, the rest of this chapter is sort of setting up the next chapters as to like how to actually do it. Again, the title of this chapter is, a general approach to common stock analysis. So he discusses finding appropriate price based on future expected earnings and PE ratio based on the industry. Remember earlier in the chapter, again, future expected earnings is difficult, and so you should be conservative, if you're trying to figure out how much you should pay for a company, obviously, in that regard. And then he notes diversified holdings are more dependable than concentrated on a few companies. And there's so many examples of this. It's like trying to pick the winners within an industry. You pick an industry and say, okay, that company is going to do really well over all of the rest. Some people are able to do that accurately. More often than not, when people try to do that, the whole industry itself grows better. So it's better just own the whole industry, basically, he's saying, than trying to pick individual stocks. But so that's a fairly obvious and a thing that he repeats a lot throughout the chapter. And we have another section, factors affecting the capitalization rate. Basically, industry-based PEs can be right or can be wrong. This has to do with the future of the industry, like railroads in general. They're not as much of a part of the world as they used to be. I would argue that shipping across the sea is probably a bigger industry than trains are today. I could be wrong on that. Correct me in the comments if you know any better. But yeah, and then you have innovation taking over certain industries. Like, I imagine we might need less paper than we used to because everything being online. There's a million examples of that, but the point here being, though, that PE ratios of a whole industry, and from my own observation, they tend to be pretty secure and don't tend to move very much. He talks about this later in the chapter, how when people try to predict the average PE of an industry is going to change because of some innovation or some shift in technology or whatever it is, that it's rare for people to predict those things correctly. So like if you have metal miners that have been trading at 10 PE for the past 20 years, and someone says, oh, that's all about to change now. Well, maybe not. But we get to that point later in the chapter. So then we have a section on the management effects, and he concludes that when you are trying to figure out what's going on with management, he says that the best use of analyzing the management of a company is when management changes. And so a company can do much better under another company's ownership, as an example of that change. Or you get a new CEO or something, and oftentimes you'll see that when a company announces they have a new CEO, usually the stock price jumps because people get excited that the company might be doing better because you have someone new. And he says this is useful, basically. And I want to note here, this is why mergers and acquisitions, not just the company being acquired, but also the company that is acquiring that company, they tend to benefit in price of both stocks, the purchasing company and the company being bought, because of the change of management. With better, more experienced, further seeing management, the company that's buying a company can actually increase its value um, just because of that. I found that very interesting. And then we have a section on financial position, basically talking about the cash and debt of a company. Like from security analysis, he mentions how, again, more debt leverages stock value. This is a very important concept to really understand, that how debt and stock value works, and how, if you don't have enough bonded debt, the stock value, if it's relying too much on the stock value, that's not actually a good thing. It deleverages basically the stock, and so you can have, it makes the prospect of owning the company just less rewarding than companies that have more leverage, and that's just based on the capital structure. Next, we talk about dividends again. On dividends for basically figuring out the value of a stock. And so uninterrupted record, he says, specifically of over 20 years means that it's a quality company. So if it's been paying out, $1 every year for 5 years, and then $1.50 for the next 5 years, $2 the next 5 years, it just keeps going up, and it's uninterrupted. They never miss a dividend payment. He does state that's the mark of a really great company. I'm going to mention that I agree with that. I think that you can find, I don't know if he'll talk about this later in this book, but I do think you can find, if a company has had uninterrupted record of dividends and then they miss a dividend payment, the markets today, a lot of funds will flush that company out of their fund because it missed that dividend payment. It's like a big alarm bell, and the price can drop very dramatically. A lot of times, not with great reason, with producing a potential very nice opportunity for the individual investor to maybe purchase, depending on a lot of the other numbers. But I have found that to be true in my own experience. And he talks about the dividend rate, how the standard is 2/3 of the average earnings, but recent higher profits and inflation lowers this expectation. Again, I'm a little surprised here that he doesn't talk about the difference of expected dividends based on the industry. Obviously, today you have stocks that pay out like 8 to 12% dividends, especially like Brazilian stocks right now, for example. And then you have companies that pay like 0.1% dividends, like some of the giant like companies like Microsoft, Apple, and stuff. And so, you have to consider the industry on that too. But anyway. All right, and then we talk about growth stocks retaining all earnings and there being no dividend, how that's kind of a complicated situation, but he says he's going to discuss this later in chapter 19, and so I'll leave that alone for now. But he does keep bringing up throughout this chapter growth stocks. He's like, I'll do it in chapter 19, but then he keeps talking about it. But anyway, we have next section, capitalization rates for growth stocks, and comes up with a formula. Basically, the value should equal the current normal earnings times 8.5 plus twice the expected annual growth rate. And we have a chart that basically shows that. And we have a quote here: the growth figure should be that expected over the next 7 to 10 years. So every year for the next 7 to 10 years, what is the expected annual growth rate? And I think this does include inflation, by the way, which obviously will play into this. And he says basically this formula assumes some margin of safety because of infinite growth. Because infinite growth would assume infinite value, and again, this is why. This gives credence to companies today trading over, 20, a PE ratio of 20, like Nvidia at like 60 or 70, and Microsoft, a lot of companies, you know, a PE ratio like that does not give you very much safety. I'll just at least say that. I talk about Nvidia a lot on my shows, and that might be correct. It might grow at an infinite rate when it comes to dollars. I mean, dollars aren't backed by gold anymore, so why not? Maybe it is currently worth a PE ratio of 60 or 80 or something like that. But this would not make Graham very happy. He would look at this and be like, yeah, no margin of safety. He only has the potential to drop in price by quite a lot. Whatever. All right, and another quote: there is really no way of valuing a high growth company with an expected rate above, say, 8% annually, in which the analysts can make realistic assumptions of both the proper multiplier for the current earnings and the expectable multiplier for the future earnings. Again, this is the kind of thing that the greater the expected growth is of a company into the future, the greater margin there is for error, and that's why you can have a ginormous company like Nvidia, I'll keep bringing it up ad infinitum at this point, that can drop or go up by 5%, 10% in one day, the value of it. Mr. Market is lost its mind in these times in 2024, but I digress. He writes a serious disclaimer stating the guessing of the future earnings are hard to predict. 5-star point, also interest rates can affect earnings. Today in 2024, interest rates have gone from historically low rates, relatively speaking, to historically high rates at a very, very high rate of expansion of interest rates. And so this is why I keep saying in a lot of my shows I'm expecting earnings contraction to, I'll say, continue, because we have already had earnings contraction as of this date. If you take a look at the Fred website, S&P 500 earnings by quarter, you can see that earnings were higher in nominal terms in 2021 than they are still today. It was something like 200, and now it's like flat at 190. And with interest rates being high, it should go down, but that makes PE ratios go up, and so that's why I really think the stock market is due for a pretty big correction today. But I digress. We have a section on industry analysis. It says that industry and industry position can help make investment choices. Rarely broker studies. Rarely can broker studies, we talked about this earlier in this video, can they predict the fall or rise of an industry? So if there's and the way I relate that is if there's like a standard rate PE ratio, and this is like common, like everybody pretty much, and it's easy to find on the internet, easy to calculate, what's the industry standard of the PE ratio of that industry. And and to try to predict that the PE ratio of a whole industry has been suppressed and is bound to change. Lynn Alden has done that, and she, she's relatively new to this whole thing, as I am. But anyway, I digress. I don't need to go into too much detail. Basically, this is very true. I want to say that it can happen, but it's very rare, and you'd have to have a crystal ball to really predict it. Wink, wink. All right, so basically, next point basically says that he values studying disruptive technology. He doesn't say in those words, but that's how I interpreted it. And then we have a short conversation on the hard reality of mispricing growth and innovation, and how horrible it is to miss opportunities or overpay for what you think has so much value in the future. And turns out later on that it didn't have quite as much value as you thought it did. I'll bring up the cannabis industry. As soon as the first ETF came out of that, man, that thing went to the moon. It was like, I don't know, something like $90 a share and went down to like $5 a share. It lost like 95% of its value within a year. um, that that was overpaying for potential growth, in a new industry, right? That applies directly to this conversation here. All right, and we'll see what the future is with that industry as well. But anyway, then we have a section called two-part appraisal process. Oh yeah, the name of the section is a two-part appraisal process. In this section, he discusses a plan for analysis involving senior and junior analysts having different jobs onto like how it can be done. And then he notes the particular usefulness for public utility stocks, basically, stocks that you can somewhat like reliably predict how they're going to be doing in the future, because everybody uses them and they have great pricing power. Some industries are even like by law guaranteed certain profits and stuff like that. And I'll add to that, probably insurance companies might fit into this category. How easy it is to assume and depend on the stability and the growth of their earnings over time. Yeah, and so he finds this as an area to be easier, more dependable way of trying to get an advantage in security analysis, basically. And then we have a point. Then the last point really is that the following chapters illustrate how to do this exactly, especially for predictable industries. And that's all we have for Benjamin Graham's The Intelligent Investor, Revised Edition, 1972, Chapter 11, Security Analysis for the Lay Investor, General Approach. Hope you enjoyed. Thank you for watching, and see you next time in Chapter 12, Rob's Child.